Now, there are concerns being raised about the US government's ability to sell its massive amounts of debt. Today, there was a very messy 5-year Treasury auction, and yesterday's $44 billion two-year auction attracted less demand than anticipated. Some investors said concerns about the huge supply of government debt has been so great overnight that the Treasury market really managed to shrug off Portugal's downgrade and a mixed bag of US economic data as well. Let's cover all of that with FIIG Securities Managing Director Jim Stening, who joins me now in studio. Great to have you in again, Jim. Thank you, particularly today with so many big developments overnight. Just give us some of the developments regarding the US Treasury auctions and these supply worries at the moment.
Yeah, okay. Well, last night we had the 5-year issue. I think it was $42 billion, and that's a record or an equal record. So there are some digestion problems emerging in that space. We had a big sell-off in yield, or a big sell-off in terms of Treasuries. I think it was something like 17 yield points on the back of the tender. The tender did not go well. It was the yields were much higher than expected, and bid to cover was a lot lower than expected. So some supply concerns starting to emerge.
Yeah, are there any particular reasons why you think that those yields have ticked up so much?
Yeah, well, I think it's really interesting because some time ago, 12 months ago, before I suppose the equity rally, we were theorising about the implications of this massive amount of issuance that has to come. So what we're experiencing now is we're experiencing it in practice.
But maybe playing out later than we would have expected.
Well, I suppose so. I mean, I think that the fact is that what we're seeing at the moment, we're seeing US swap spreads or Treasuries move up through swap spreads. We're seeing tenders being having problems being placed. These are genuine supply concerns, I suppose.
And of course, what about the effect of the continued assurances from the Fed Reserve that interest rates are going to remain low for some period, or borrowing rates, people are looking for maybe higher returns somewhere else? Does that play into it?
Well, I mean, interestingly, what they're looking at in the US is to keep longer-term rates low. And with the supply concerns and tenders not going too well, that's not actually a good outcome for what they're trying to actually achieve. Okay. A lot of borrowing's done on fixed rate, particularly mortgage-backed borrowing. So
what are the implications of what's happening there in the US Treasuries for the broader scheme of things?
Well, I mean, what we're starting to see is an emergence of discussion about sovereign debt globally. I mean, we sort of went to sleep, I suppose, on the Greece issue, and that sort of reared its head again last night. We saw the downgrading of Portugal. So these are things that are just not going to go away, and the focus is really on sovereign debt. So looking around the world, people are saying, well, do we need more of a premium to invest in these assets? So yeah, I mean, I think what we're seeing is genuine supply problems. I mean, the fact that we've got US Treasuries through swap rates or above corporate curves, it means that arguably the appetite for bonds is pretty well sated at the moment.
Well, and this is fairly unprecedented, or?
What we're seeing at the moment is very rare. I think in Australia we had an episode back in the early 90s where government debt traded through the swap rate. And it was there for quite some time, but in hindsight that turned out to be a great arbitrage opportunity. It just doesn't make sense that you have zero risk assets yielding more than corporate debt.
So do you, in kind of concluding this part of the segment today, do you actually have concerns about the massive amounts of debt and the ability of the US to sell that?
Well, I think so. I think at the moment it's workable. These are little blips along the way. I think that the issue is going forward. If in fact growth doesn't evolve, or we don't see the growth in the US economy or the recovery develop, in fact it goes the other way, then more debt's required. So what's factored in is, I suppose, a lot of debt coming downstream, and potentially that diminishing over time in terms of the ongoing supply. If in fact that's wrong, then I think we will see a jump up in longer dated yields.
Do you think this will be a cloud for the equity markets, or will the equity markets just shrug it all off?
Well, I think, as far as allocating to risk assets go, these type of bumps in the road are going to be happening over the next 6 to 12 months. It's not going to go away. We're going to see further sovereign downgrades. And I think, as an investor, you've got to ask yourself, well, not if, but when will the UK be downgraded, and how will that impact on my portfolio? So, things like Dubai, Greece, Portugal, Spain, Italy, whatever, these things are going to unfold in the next 6 months. So in terms of your asset allocation, you really need to factor that in.
And you briefly mentioned earlier the downgrade by Fitch of Portugal overnight. Why have they actually done that? What we kind of ascertain is the reasons?
It's the usual reasons. They don't think that that growth is going to come through into that economy, and the amount of debt that they have to issue means that they're a less viable borrower.
Okay, and obviously adding to the concerns about Greece, so we're seeing similar kind of story, another weak link for the euro?
Yeah, that's right. I mean, it's a death of a thousand cuts. I don't think we're going to see downgrades of massive notches. It's going to be slowly but surely these things will emerge.
And you just mentioned UK as possible recipient of a downgrade. Is that the most likely? But that would be the
well, I mean, there's talk about the US. There's talk about the UK. There's talk about Spain.
Would the UK be a big blow though?
Well, I think that's a good question you have to ask yourself as an investor.
Yeah.
You know, what if that happened tomorrow? How would equity markets react? And I don't think it'll be a favourable response.
And again, just sort of broader implications. What's the main message for people then?
Well, I just think that it's about asset allocation. I think that until these sort of, if you like, the vat of sovereign debt is not stopped slurping over the sides, if you know what I mean, until that's resolved and we see growth, then allocating to riskier assets doesn't make a lot of sense in this environment.
Jim Stening, good to have you on. Thank you so much. And as I said, great day to be having all of that to chat to you about. So thank you. That's Jim Stening there from FIIG Securities, Managing Director.